My name is Julianne Peterson, and I welcome you to tonight's Zoom at 8. I'm Julie again with Old Capital Lending, and as you know, we are a little bit different than most brokers. We help you put the deal together. I work with and help a lot of new investors in the multifamily sector, and we help you be educated and also serve you by preparing you well to take down your first, second, third, and many more to follow. So if you're looking for a sponsor, a limited partner, if you're looking for an attorney, insurance broker, anything that we can do to help put your team together, I'm happy to do that for you. And if you find that this time together on Tuesdays at 8 o'clock Eastern is something that has made a difference in your life, please share it. Make someone else a little bit smarter than the rest of us, or maybe bring them in and maybe they can help share their talents with us as well. Tonight, I'm super excited. I know I say that, but tonight I have one of the top investors in real estate with us tonight, and it is just such an honor to be with you tonight and to share Mr. Keith Weinhold with you tonight, the founder and host of the weekly podcast, Get Rich Education, where he speaks about abundance mentality, to invest in real estate for the outcome of not how many more doors you can buy and not about more cash flow, but how that conduit actually improves your lifestyle. He has over 3 million listens on this podcast of his, and I would certainly like to see 63 more people in our group here take a listen to it, because it is amazing. Keith says, build your wealth and cultivate an abundance mindset. You know, he has taken some really bold moves and just simply leaving Pennsylvania and moving to Alaska. That is a bold move. Keith is a humble man from Appalachia who knew nothing about landlording and made some embarrassing mistakes. That's what he said, not me. But he was motivated initially by Rich Dad Poor Dad when he bought 2 4-unit complexes, which began back in 2002. His belief system is greater to look ahead than to look back. In 2017, he became the best-selling author of 7 Money Myths That Are Killing Our Wealth Potential. Keith, I am a long-time listener, and I feel like tonight that I'm 4 years old and I'm getting to meet Mr. Rogers. I know I told you that, but I have to tell everybody else, this is like meeting my superstar. I've been following you for several years, and Lane Bean was the one that introduced me to you. And, you know, specifically what continues to interest me about you is the mind-altering power of investing, especially through real estate. You talk about today's economy in COVID, to live where you want, go for what you want. Who is saying this? You have taken action. I want to just really welcome you to your first meeting of Zoom at 8. Many of us come from a single family background, and then so many of us are scaling to multifamily. But so many of the tenants are the same, but the mindset and the metrics still apply, which is why I wanted you to speak with us tonight. Keith, how are you?
Hey, great. Thanks a ton for having me. Yeah, with the Mr. Rogers stuff and you putting out this rule about there being no profanity, I'll try to keep my only 4-letter words, debt and loan. I'll try to stick to those 2 4-letter words.
Oh, so that's excellent.
Hey,
listen, I wanted to ask you about this saying that you say, don't quit your daydream. Now, we've heard of don't quit your day job, but I want to know about, how do you not quit your daydream? How did you come up with that saying?
I don't think it's original. I heard it somewhere else before, I think. But yeah, it is a play on words of you might quit your day job through residual income from real estate, but don't quit your daydream, which is building residual income through real estate. And yeah, it does start with having that abundance mindset. But hey, I just wanted to say it's a pretty impressive crowd that we've got here. You're really involved, engaged, and doing some different things. Someone said they did a 1031 with a tick. Like, I don't think I've done something quite exactly that sophisticated. So I really appreciate what you're all doing out there. And with the things I'm going to talk about today, hey, maybe some of these things won't work for you. It's not like I think I have all the answers. This is just what's worked for me. So, maybe you'll at least get one good idea. But yeah, it really begins with that power of thinking differently. And I think to the lay person on the street, if you would ask them, now, if you think you would need to acquire wealth, would you have to begin to think differently and then follow through and do differently? And I bet that person would probably start nodding their head and they would say, yes, I probably would. But then you know what? As soon as you start telling them what those things are, they're scared and they don't want to do it anymore, even though they just agreed with you a minute earlier. So, we talk about thinking differently. This morning when you woke up, you did not wake up to be mediocre, but really that's what most people do. You're probably not so mediocre if you're here, but a lot of people, when they come of age, they finish high school, trade school, college, no one really ever tells themselves that they're going to go out there and live a small life. But then that's exactly what every one of those people does, or I would say at least 95% of them. So it does take that outsized thinking. And when you think about visionaries from Henry Ford to Steve Jobs to Elon Musk or Sarah Blakely, they all made pretty extraordinary decisions in their lives. You need to make great sets of extraordinary decisions to have an extraordinary life yourself. You kind of want to do those things that make people like in your old peer group say, you're going to do what? You want to do what? If you're well thought out, and you're making quote unquote normal people say, you want to do what? That might actually be some good guidance that you're on the right track. Jeff Bezos quit his high-paying Wall Street job at age 30 to start Amazon. I mean, he burnt the bridge behind him, and so have a lot of visionaries. So that really ought to give you a lot of faith in real estate, because a lot of times in real estate, it doesn't have to be that risky because you're typically building it on the side. So this sounds like such a simple thing to say, but if you don't go for what you want, then you're never going to have it. And, I really wouldn't want to ask people to make outsized decisions if I hadn't made some myself. Julie mentioned that one of those going out on a limb sorts of things that I did is more than 15 years ago, I moved from Pennsylvania to Anchorage, Alaska, of all places, and that's where I am today. I dreamed of living there because I had vacationed there. It fit my interests for skiing and mountaineering, but yet I'm still in a city of 300,000 people, so I have plenty of amenities and choices. In 2002, I made my first ever property at all, my first ever piece of real estate, an Anchorage, Alaska fourplex building. It was a little daunting to me. This $295,000 fourplex building in Midtown Anchorage, Alaska. I had only been a rent-paying tenant up to that point in my life. I had read Rich Dad, Poor Dad. I was still kind of scared. I was still kind of intimidated about this. But you know what really brought it into my circle? And you've probably heard the quote from the late business philosopher Jim Rohn. You are the average of the 5 people that you spend the most time with. Well, I had surrounded myself with some aspirational friends after settling down in Anchorage. You are the average of the 5. They were aspirational for me. 2 of them had bought a fourplex building. That kind of gave me this context where I knew that I could do it. But if you want to change yourself, Jim Rohn would tell you, change your 5. Take the 5 people that you hang out with the most, average their fashion sense, their educational attainment level, their ethics, their values, their morals, their athleticism. You average that, and that's pretty much who you are. So if you want to change yourself, change your 5. And if you don't know, this is something very actionable for a real estate investor, especially one that's just starting out. I bought that fourplex building. I didn't have a lot of money. I was just working a day job with just a 3.5% down payment, living in one of the units for at least 12 months. And all you need is a minimum credit score of 580, and you can own an entire fourplex building. That's as big as you can go with an FHA loan. It's a great way to start with a bang. And you know what? I didn't even know what the terms cash flow and equity meant until I had owned the building for a number of months. So I think there's a bit of a lesson in that. Sometimes it's okay to start a little bit before you're ready, as long as you think that your trajectory is right on. Around 2014, I launched the podcast and quit my job. Another really unusual thing to do. A lot of people didn't even know what a podcast was in 2014, but I had built up substantial residual income from real estate, so I had the confidence that I could do this. So Mark Twain has a great quote. It's actually one of his lesser known quotes, but I think it really applies here. Maybe it applies to you and what you're doing and what you're thinking that your aspirational things are going to be. Mark Twain said, "Go out on a limb. That's where the fruit is." I absolutely love that quote from Mark Twain. So really, if you're going to have a healthy fear of anything as you go out on a limb, you should have a fear of being normal. That's where the fear should lie, really. So those are just some of the mindsets. And I think it can best be encapsulated with, don't live below your means, expand your means. That's probably what you want to do to get more out of life. That's how I see it anyway.
So tonight I wanted to talk about money. So you kind of talked about
Yeah.
money in doing your first transaction. First of all, I'm very curious. Did you know when you moved from Pennsylvania to Alaska, did you know anything about the weather? Did that ever have cross your mind that maybe, those are going to be some tough winters?
It sure did. In fact, it's about 12 degrees Fahrenheit out right now here in Anchorage, Alaska. That is somewhat chillier than normal, but I mean, it's a mindset. The way I see it, if I'm in, I was just in the Sonoran Desert of Arizona a few weeks ago. If it gets really hot, I can only take so many layers off. But if it's 12 Fahrenheit, I can just add the layers. So
I had that same thought from Chicago.
yeah, right. Yes, yes. The weather sure was a consideration.
Okay, so we talked about money. I'd like to talk about mindset. There's this thing that you talk about, abundance mindset filters. You realize, then you decide, and then you educate, and then you act. It's 4 pillars. And you talk a little bit about people getting derailed between the second one, which is decide, and then the 4th filter, which is act. Was there ever a point in your real estate adventure, if you will, did you realize, and when did you decide? Was it after you accumulated the first or second property, or was it after you sold? When did you realize and decide? Curious.
Right after owning that first fourplex building for about 3 years, I really didn't do much. I only had to live in that building 12 months to qualify for the financing. I lived in that fourplex for the first 3 years. I was into other things, travel and athletic competitions and things like that. It wasn't until I did more reading. And I think one thing that I learned that a lot of people still haven't learned is that financially free beats debt free. That's what helped take me from decision to acting. Doing a cash out refinance of that first fourplex building and using some of that of accumulated equity to go ahead and buy a second fourplex building with essentially none of my own money because it was accumulated equity from the first building. Now that right there would give some people pause because they're saying, wait, you're removing equity from the first property and putting it into the second property, then aren't you taking on more debt? Aren't you getting highly leveraged or over leveraged? As long as income exceeds expenses, I'm not over leveraged. The debt is good when it's outsourced to tenants. You think about it, when you buy a cash flowing property, or maybe you're a real estate syndicator and you're trying to explain to investors what you do, when debt is good, it's outsourced to tenants. So that increased the total value of properties that I could own, and it increased my cash flow. So even though I'm taking on more debt, that debt is outsourced. But paradoxically, I'm actually getting closer to financial freedom because it increases my cash flow at the same time. So taking on more debt like that is responsible all day when it's done right. And there's some other important things there. You need to be buying in the right market and things like that. That's when I realized financially free beats debt free. So that crystallizing that helped me grow and decide to grow.
Amazing. And so that time period was only about 12 months that you were in that situation where you had lived in that property.
Well, yeah, I only had to live there 12 months, but I lived there a little over 3 years in that first fourplex. Like real estate investing just wasn't the number one thing in my life. But I started to read more, and as values were really going up in real estate between 2002 and 2005, and I started to realize how real estate makes ordinary people wealthy. When I have just a 3.5% down payment on a property, that is 28 to 1 leverage. So with just a 5% gain in the value of the building, it's a 140% gain on the little equity piece that I had put inside it. And really, that's another epiphany. It's leverage and leveraging other people's money that builds wealth, which I'm going to say something heretical here, but it trumps compound interest for growing wealth. So these are some of the decisions: using leverage, realizing financially free is where it's at and not debt free, to take me from decision to acting, Julie. That's really a big part of what it was.
I want you to say that one more time, because I think that there are a lot of investors that recognize that everybody is doing this, but they don't really understand the concepts of the debt versus the leverage, the benefits of that. Is there another, I know that you took on more debt with the two properties, and then you got more tenants, right? And you talk about having the tenants pay, right? You get them, you walk away with only, you got the appreciation, and you've got the cash flow, and you've got the tax incentives, all of these, and the loan amortization. All of these things play into making a decision to put yourself in debt, right? The advantages of that. Could you talk to us about that?
Yeah, you're talking about the 5 simultaneous profit centers one typically has when they invest directly in real estate. Here's what I think is what you're talking about. It's conditional. Debt doesn't have to be a bad thing. Let me just drop back for a moment. And Brett Favre was one of the greatest quarterbacks in NFL history, Hall of Famer. He threw more interceptions than any quarterback in NFL history. Cy Young, one of the great baseball pitchers of all time, early inductees into the Hall of Fame. Every year they still give an award to pitchers called the Cy Young Award because he was one of the greatest. He lost more games than any pitcher has ever lost. $20 million in debt might sound like a poverty marker to most people, but you know what? If you see a person on the street and they've got $20 million in debt, there's a good chance that that person is a winner in finances. How can that be? Doesn't that sound so intuitive, counterintuitive? Well, if you've got $20 million in debt, you must be a pretty credit-worthy person to have ever gotten that much debt. And we're only looking at one side of your net worth sheet here. If you've got $20 million in debt, there's probably a good chance you have a lot of assets. Maybe you have $50 million in asset value as well. So sophisticated people and savvy investors often have debt. We know today you can borrow at a 3 or 4% interest rate, maybe 5% interest rate on some apartment buildings, and you can arbitrage that. Arbitrage, it's a complicated sounding word, but it means that you borrow at a lower rate, say 4%, and reinvest those dollars at a higher rate, 10%. That difference, that 6%, being what's known as arbitrage. So one does not have an aversion to debt when they realize that it's good and they can use arbitrage. Mark Zuckerberg and his wife, when they bought their home, they're fantastically wealthy. When they bought their home, they took out a loan. Why? They know they're creating arbitrage. They couldn't afford to have whatever their home cost, $10 million tied up in their home, when they can have that out there for assets. Now, that's debt that they actually have to pay themselves. You can outsource all of your debt to a tenant in a cash flowing rental. So really, debt is good in 2 instances. Number one, like I said, when it's outsourced to tenants, or secondly, when the interest rate is even lower than the rate of inflation. Well, that means that you are actually making out because the debt is being debased even faster than accrued interest can that you would have to pay. So you're actually using good debt two ways at the same time if you're able to borrow for less than the rate of inflation in a cash flowing rental. But it's about buying a durable rental. You want to have durability in those income streams from tenants over time. It's never a 100% chance you're going to have that. It's never a guarantee. It's buying in the right, vibrant market where you have a reasonable expectation that you're going to have tenants that can pay the rent for a while. But those are some of the mindsets that allowed me to want to take on more debt and embrace more debt, as counterintuitive as it seems. Just back to how I started this, you can't think mediocre thoughts. You need to have outsized thoughts if you're going to have an outsized impact financially, and then you can buy time to do what you want to do.
Amazing.
Yeah.
Now
So,
that also talks about, you talk about ROTI.
oh
You
yeah.
kind of brought that in, with your time. Can you kind of bring us through that return on time invested? Tell us about that.
Yeah, a lot of people talk about ROI. What's your return on investment? I introduced the term a while ago. ROI matters, but what about your ROTI, your return on time invested? At your job, you're typically trading your time for dollars. You're constantly selling your time for money at a day job, and that might be okay. But your return on time invested, if you can buy a property so well where the income exceed the expenses by such a substantial margin that you can hire a property manager and have the property manager in there, now your income streams are residual and almost passive. So I don't manage any of my own properties, even for the apartment buildings that I own here in my own hometown of Anchorage. I also own ones in other US states, because I consider what my return on time invested is. And it's really about learning and implementing things like arbitrage and leverage and using those in your portfolio. So leverage and arbitrage are often out there working for me. So that gives me a good return on time invested. I don't manage any of my own properties. I did for the first 5.5 years, but I haven't in years. And that often throws off people. They think I must be managing certainly my own properties in my own hometown, but no, I wouldn't do that. The opportunity cost would be too great. I want a good return on time invested in these things. It's not to be the one getting text messages about flooring that delaminates or a faucet that needs repaired or something like that, which works out because I'm a lousy handyman as it is.
Yeah, well, you set your priorities. Like, look at this picture, everybody. This is Keith on the top of this mountain. I see this oftentimes on his posts on Facebook and LinkedIn. So what I think is so amazing is the fact that Keith has committed to traveling and his fitness. I mean, he's amazingly fit. I'm curious, being as fit as you are, there is a commitment to how like does it pass over to your investing, keeping that strong sense of mind and fitness. I'm a fitness instructor as well,
Yeah.
so you're always trying to push yourself a little bit harder. Do you see some of the similarities with your investing?
Yeah, I think someone might say, what in the heck's a correlation with fitness and real estate investing?
Yeah.
Fitness and finances, like how does that tie together? What's the common thread? When you become a successful real estate investor and you're going to have income streams coming in throughout your life and they are durable, they're going to last for decades. Well, I want to be fit and alive and be there to enjoy it. Maybe if I were in some lousy 401k with some awful choice in a basket of mutual funds that I didn't think was going to provide income till I'm 70, then I wouldn't really care if I died until I'm 70. But no, I care. We're building income streams here. So really, I think about lean musculature and longevity. Those are like really my mission with exercise. And yeah, I do like to get outdoors hiking, and it looks like I'm standing like at the pinnacle of a tall mountain there, and it's so treacherous to get up there, but it really isn't. You can kind of walk up the backside pretty easily. I'm not doing anything death defying there, but yeah, with what you see over Julie's shoulder, that's the peak of a mountain near Anchorage. It's a 35-minute trip from my home. You start the climb at sea level. Anchorage is a sea level city, and go up to just 3,500 feet there. That's all that is. But really, health is wealth. I think they go together. I don't want to talk about health stuff too much on a real estate investing show, but I like to exercise in the morning. Research shows that if you exercise in the morning, it actually keeps your metabolism at a higher rate all day. And, I like to do actionable things to help people. I can improve your health in as little as 5 seconds if you're watching on a phone. Don't look down at your phone like this. Hold it up here. It's better for your posture. It's better for your neck. I was at Seattle Airport a couple weeks ago, and the plane was a little bit delayed, and everyone's looking down at their phone like this. And I'm the only guy holding up my phone like this, using good posture. But you know what happens? A couple people are like, "Hey, are you taking pictures of me? What are you doing?" No, I'm being healthy. So yeah, it gets a little awkward sometimes being healthy.
Oh, that's excellent. Well, I know I've heard you say this, and I think it's awesome. Everyone owns a multi-million billion dollar asset. It's your mind. I think that you really have a very strong mind. Is it possible? It's what's in your mind, really, and what is it telling you?
It is really our only limit is in all of our minds, and that includes me. Even I can stretch myself more and think bigger. And part of thinking bigger is really the word millionaire itself. A lot of people have a goal of being a millionaire, and maybe there's nothing purely wrong with that. But depending on your outlook, you need to be thinking about things like inflation. $1 million over 30 years at a 4% inflation rate is going to give you only 308K of purchasing power. That's all you're going to have in 30 years as a millionaire. A millionaire just means you have $1 million in net worth, assets minus liabilities. So it's about thinking bigger. And the book you mentioned, 7 Money Myths That Are Killing Your Wealth Potential there, Julie, one of the myths is you think you want to be a millionaire, but that's going to be woefully insufficient. So it's about setting bigger goals, and the appropriate goal. Yeah, you got to keep inflation in mind with that too.
I wanted you to talk to us about inflation, because we've got a new president, and we're hearing that, well, some days you hear there's going to be, the feds are going to hold down the rates for 3 years. And then I get a note that says, oh no, we're raising the rates. We see the 10-year treasury has increased over the last 2, 3, 4 weeks. I'd like to hear your thoughts. I know we're talking a little bit about inflation and what your thoughts are moving forward in this, the new environment.
Well, as a real estate investor, inflation benefits us. I've talked about how real estate investors win the inflation triple crown. You actually win 3 ways at the same time. But let me drop back if someone doesn't quite understand inflation. The classic definition of inflation meant inflation of the money supply, a greater money supply. But really the modern definition, and the definition that you care about, is the rate at which the purchasing power of your dollar diminishes. The 100-year trend line of the dollar is such that it's lost its purchasing power by about 30x over the last 100 years. So inflation is pretty low right now. If you go, you can always check the official government reported statistics at bls.gov/CPI. By the way, the Consumer Price Index, they track this there. It's currently at just 1.4%. So your dollar is currently losing 1.4% of purchasing power each year. Yeah, Julie, you talked about some of these things like the stimulus bills that have been introduced. And now that we've had a change in political regime, some think more of those stimulus bills are going to come, and they're going to come faster. And part of the reason for that is people think that more shutdowns are going to occur because of the change of regime. So if you think about it, more shutdowns would probably then lead to more stimulus. Whether you agree with it or not, it's just good to see what's coming. So some think all this money printing, like in the recent $1.9 trillion bill that was floated out there, well, that's got to increase inflation. It doesn't necessarily have to increase inflation. I think we learned this coming off the Great Recession from 2007 to 2009. The Fed printed a lot of money to try to pave over the problems with the recession that we had then. A lot of people were predicting inflation, but it didn't appear. Why didn't it appear, even though they printed lots of money? It gets really nuanced. Some people don't really even know the answer, but a lot of it never got into the hands of consumers. We need a velocity of money to get moving in an economy in order to create demand for products and push prices up. But right now in this recession, in this low demand environment, it's difficult to get inflation, even if a lot of dollars are printed, if they're not circulating in an economy. But one way that you need to understand that inflation benefits real estate investors, we were talking about the amount of $1 million a few minutes ago. If you have $1 million in debt, real estate debt, okay, we know that the tenant is paying that down for you. They're debasing your debt. But if you have $1 million in real estate debt and we have a 3% inflation rate, after year one, you only owe the bank back $970K in inflation adjusted dollars. And you only owe the bank back $940K after 2 years and $910K after 3 years in inflation adjusted dollars. See, the bank doesn't ask to be repaid in inflation adjusted dollars, just nominal dollars. Nominal means in name only. And of course, the tenant is paying the interest for you all this time. So inflation transfers wealth from lenders to borrowers. That's why I want to be a substantial debtor. Inflation also transfers wealth from older people to younger people. Now, why would inflation transfer wealth from older people to younger people? That's because older people have more assets and younger people have more debt. So as I age, I want to keep my debt. So
really interesting.
That's how inflation erodes your debt and why inflation is good for real estate investors with that smart debt.
You don't hear anybody take this position. It's, everybody says, oh, inflation is bad. So listening to you is a real eye-opener, I'm sure, for our listeners.
Well, yeah, inflation is bad to most people that are just working at that consumer credit level. What's inflation mean to most people? Your $8 Chipotle burrito goes up to $9 and the consumer sees that and that hurts them. But to me, hey, maybe that's an indication that there's inflation out there. Oh, that might be good for me long term. So yeah, I don't mind paying a dollar more, even if the Chipotle burrito has the same ingredients and it's the same size for $1 more. That might be an indication of inflation.
I want to talk to you about the myths in your 7 myths in your book. Live below your means is one of them. I'm going to take you through all of them so everybody hears them. Live below your means. This is a myth. Get your money to work for you. Be debt-free. Compound interest can make you wealthy. We talked a little bit about that. Millionaires have got it made. Home equity is a smart, safe, and sound investment. And retirement plans are wise investment vehicles.
And these are all myths.
These are all myths that you have identified, which, there are other people that we listen to who these are not myths to them. These are truly the way that they speak to their audiences. So I would like for us to talk a little bit about be debt-free. I'm curious. We talked a little bit about it. As we're aging, a lot of people say, no, I want to refinance my home and I want to pay it off. And then I don't have to make any more payments. I'm home free. I can be a limited partner in a multifamily, but I have my home. I don't have to work towards it. It is secure. I would like to hear your thoughts on that, because I'm sure Mr. and Mrs. Weinhold, who live over in Pennsylvania, I think they probably have that mindset. Is that right? Or have they changed?
No, they do. My parents in Pennsylvania, they've had their home paid off for decades. But my dad says, listening to my show, now I understand, Keith, that doesn't necessarily make the most sense. So I think one needs to realize that the return from home equity is always zero. In fact, home equity is also illiquid and it's unsafe. The market can take it away. So the return on equity, that's something different. That's a different calculation. What I said is the return from home equity or even equity in your rental properties doesn't have any rate of return. So Maybe we can just come up with a couple extreme examples as to why I keep the maximum leverage on my own home, and I know equity doesn't have any return, but borrowing against it incurs a small interest expense. Let's say if you have a $300,000 home and you have 100K of equity in it, meaning you have a 200K loan. Okay, and say your 300K home goes up to 330K in value. It appreciated 10% over time. Well, let me ask you, did that have anything to do with the amount of equity that you had in the home, that 100K?
Mm-mm.
No, it's got nothing to do with it. Homes appreciate in value or depreciate in value, the same with an apartment building, not based on the equity that is inside the walls of the home, but rather all these factors outside the walls of the home, like the remaining availability of developable land or wage growth and price growth or things like that. But conversely, if your 300K home where you have 100K in equity in it, if that 300K home drops down in value to 200K in a bad recession, well, now your equity is 100% wiped out. So you start to understand why I say that
Mhm.
it's unsafe. It has zero rate of return and it's illiquid. It's kind of like a one-way street. If you put the equity in, if you put an extra $100 principal payment on your mortgage, basically here's what you're saying. Hey, Mr. Banker, here's an extra $100 principal payment. Don't pay me any interest on it. If I need it back, I'll pay you fees and I'll try to prove to you that I qualify again. So
Mm.
I practice what I preach. I mean, I wouldn't want to have my home paid off by the time I'm 40 or 60 or 80. I would
Hmm.
rather use that equity on an income property in a different market. That's actually less risky because now I'm diversified into two different markets. And when I take equity from my home to put it into an income property, no equity was lost. Equity is merely transferred, although you might have a corner chipped off for some closing costs or things like that. So to summarize, the return from home equity is always zero. It's also unsafe and illiquid. But yes, if I do take a loan against my home, it's my responsibility then to go out and beat that interest rate that I'm paying on like a HELOC second on my home or refinancing the whole thing. It's my job to go out and find a cash on cash return that's going to meet or exceed that cost of capital from borrowing against my home. Then I'm ahead. Then I have two properties where I can enjoy all those five profit centers of real estate investing: appreciation, cash flow, the return on amortization, the tax benefits, and the inflation profiting that I described before. So I'd rather expand and have a big portfolio. I know that some people have this feeling that they would just feel better if
Mhm.
they get their primary residence paid off. And I can't tell any person that they're wrong or they're dumb for doing something like that. But one other thing I'd consider, and maybe you do have your home paid off, having your home paid off, it doesn't make your housing payment go away. It just makes your principal and interest payment go away. You're still going to have a housing payment that might be one quarter or one half as much as when you had a mortgage on it, because you're still going to have to pay property insurance and property tax and utilities and maintenance and repairs and so on. So even when you get the loan retired, you still have a housing payment that you have to make anyway. So I don't know if winning would really even feel that good or that fulfilling. So those are the mindsets around how I think of home equity, but it starts by understanding that it doesn't have any return.
That is brilliant. I'm curious, where do you find all this knowledge? Who are some of the people that you use as your resources to just build your knowledge? I know we talked about Tom Wheelwright. We've talked
Yeah.
about Robert Kiyosaki, Hal Enrod in his way in his morning meditation. But what about who else that maybe would be somebody that we would want to follow, other than you, of course?
Well, it's probably two parties you've heard of. I mean, Robert Kiyosaki and Sharon Lechter, who are the Rich Dad School
Mhm.
of Thought and the original authors of the book Rich Dad Poor Dad, they really helped mold my mindset. And then the real estate guys, Robert Helms and Russell Gray,
Mhm.
they helped me make that Rich Dad mindset actionable. So I'd really say those two parties are my greatest influencers with how I think.
Yeah, they are all great
Yeah.
resources. Thank you for sharing. Okay, so we have just about 10 minutes. I've got a couple more questions. Tell us what you're working on now. Are you selling? Are you buying? What are you working on? Anything in particular for whether it's single family, fourplexes or duplexes, or I'm sorry, multifamily?
I'm working on geographic market restructuring, and I am trying
Mm,
to move my equity from my home state of Alaska into other states. I do have like a couple apartment buildings here where the balloon payment would become due in about 2 years. So
mhm,
that gives me a deadline to want to move those properties. And the reason is, and there's a great lesson for you, the real estate investor, in this, regardless of what market you live in, it's that the market is more important than the property. I need to get out of the Anchorage market. And unfortunately, that's because
mm,
we were in a recession before the pandemic even began. And that all comes down to one word, whether you like this word or not. It's what drives the local economy here. And that word is oil.
mm.
In late 2014, the price of a barrel of oil started dropping from 100 down to about $50, and it hasn't recovered. Local oil companies are not making new infrastructure investments. So people need to move out. Oil companies have had to be lean, and those people are completely moving out of state. So my rent income has actually dropped in my same properties, and I just don't see it turning around anytime soon. So really the lesson for you, I
Mm,
touched on it earlier, is that the market is even more important than the property. So, I mean, you asked me what I'm doing now,
mm.
Julie. That's where my thoughts are. The population of this city is decreasing. The amount of jobs are decreasing, and the four lease signs that you see on commercial properties are replete. There's an awful lot of them. So I think there's a
Oh,
real lesson there.
yeah, I'm sure a big lesson. The other question I have is if you were 21 years again today, you're 21 years old, what would you have done differently? Would you go into syndication? Sounds like maybe Alaska might be a place where you would vacation as opposed to buy. What can you share with us a little bit about that?
Yeah, I haven't thought that through. It's hard to say. I think I would not have been so scared to take action sooner. Like
Mm,
that's what I would have told my 21-year-old self. Yeah, it's not just buy that property sooner, but it's go out on that limb like Mark Twain did sooner. Ask that attractive girl out that you think's a little bit too.
mm,
Maybe she'll say yes. I think we all regret the things that we did not do in our life more than the things that we did do, and I'm really in that same camp.
interesting. Well, it is such a pleasure to have you on. I do want to make sure that everybody knows about um, your book. And let me sit aside, make sure that everybody knows about it. It is The 7 Myths That Are Killing Your Wealth Potential. So this is available on Amazon. Is there another way to reach out to get your books?
Yeah, I'm giving away that book for free right there at getricheducation.com on the homepage. 7 money myths that are killing your wealth potential. We touched on about 2 of the 7 tonight. And,
Mhm.
it really gives justification for things that we talked about here. Another one that we didn't get to is people think that compound interest builds wealth. I describe in that book why it doesn't. And the problem with most books is they're just too doggone long. They're 425 pages or whatever. We have both a financial education problem and a reading problem. So this book is 84 pages because I wanted people to be able to actually get to the end of it and feel like they accomplished something. So, yeah, 7 money myths where I expand on what I talked about today. And numbers don't work so good over a format like this. So I get into some of the numbers in the backup in that book. It'll really stretch your mind. Again, that's at getricheducation.com. And yeah, I do the Get Rich Education podcast every week. And I mean, every week since
Yes.
2014. There's no passive income in podcasting. It is work to put together a show every week. So yeah, hopefully you can listen to me there every Monday at the Get Rich Education podcast.
Oh, that is fabulous. I think we have maybe 5 minutes. If somebody has a question,
Yeah,
I would
love to.
love to open it up for a couple questions.
Sure.
Um, let's see. Does anybody have a question in the group? I'm going to open up my
Hey,
gallery
Christina
view.
with their hand up, Teo, Lane.
Okay, Lane, what do you got for us?
Hey, Lane.
Hey, Keith. Hey, thanks so much. So enjoyable to listen to you say that. You mentioned that you were diversifying to different markets. What are some of the metrics that you use to select those markets, and how do you go about selecting? Where do you find that data, or do you just get it from Robert Helms and the Radio Real Estate guys?
On the macro scale, I look at net in-migration. You might know that U-Haul released their, they don't call it net in-migration, but U-Haul released their data. They can see where people are driving trucks from, and they go ahead and chart the one-way truck traffic. Tennessee was actually the #1 state. Florida's been in the top 5 consistently. Like I've been doing a lot of my own buying in Florida. I had been doing some in Texas. Texas is still a good state, but yeah, Florida just has that constant net in migration, meaning more demand for housing. Of course, I think we know Florida is an income tax-free state. That sure does attract a lot of people as well. So yeah, it's really markets in Florida. I think from a cash flow perspective, if you want to get an 80% loan, places in South Florida like Miami don't work so well, but we're talking about more outlying areas outside of Orlando, Tampa, Jacksonville. I like a lot of those places, Ocala even.
Not California? No.
It's a
Just
beautiful
kidding.
place to visit.
Anybody else have a question?
I just want to say Sarasota, Florida, #2 on the hit parade.
There you
So
go.
if you're looking for some nice properties here, we're here for you.
Yeah, and spring
Excellent.
training baseball too, right? So yeah.
3 the Braves, the Orioles, and the Pirates.
Yeah, you got it all, Bruce. Nice.
Teo, you had a question.
Where's Teo?
Yeah, thanks for all that wealth of information. I appreciate it. I've certainly been listening to your podcast for a little bit of time.
Oh, thanks.
What would you recommend for a late 40-something, 47 to be? I hear a lot of these great stories of people that got into investing when they were younger, maybe before they were married, before they had kids.
Yeah.
What do you say to someone who is probably the primary breadwinner, is married, has kids, has a mortgage, and looks at like passive investments, which are great, but it's kind of like, how many $50,000 and $100,000 deals do you do
Right.
to get rich or to kind of replace your W-2 income? And what I live in Los Angeles. That's one problem I got to figure
Okay.
out. So that I know. But what do you recommend to someone like that who is trying to really take that leap, but has a lot of responsibilities and has to really tread carefully with the decisions they make?
That's a good point, because not having children, I need to let you know, like, that is part of my journey. I don't have children. So I guess it does allow me time to, research and look into some more of these things. But I'd ask you, Teo, first, I think get clear on what do you want real estate to do for you? Would you like to kind of build income on the side with it so that you can just retire somewhat earlier? Or do you are you just in a job that you just completely want to get rid of? So you want to accelerate things? If you really want to accelerate things quickly, dipping your feet in the water and getting experience with owning some real estate directly can give you some real credibility if in just 2 or 3 years you would want to get into something like real estate syndication, a way to go bigger, faster. I think a lot of it depends with you and your timeline and your goals, but it sounds like you are aware that, you are going to need to invest out of market in most cases to get passive cash flow with a 20 to 25% down payment. Los Angeles area, it kind of has those rent to purchase price ratios of maybe 0.3%. You need something like 0.8% to kind of get that cash flow just in general. So, those are some ideas, but I really recommend starting. And when you get leverage in some smaller properties, you 1031 exchange that into larger properties. If syndication is something that might interest you, that is a way to go bigger, faster, but you would want some experience first. Syndication means you're identifying like a big apartment deal, bringing investors alongside you. You'd have a lot of credibility if you bought out of state income properties and you made that work, because you could show proof of concept to investors and make them want to come alongside you, Teo.
Yeah. Yeah, no, I
Well,
appreciate that. Thank you. Yeah.
yeah, thank you. Well, I told you I'd get you out of here right on time. You are
Right on time.
welcome to join us for networking, but I do know that you've been busy all day. We're at the end of your caboose, so I want to thank you so much. I feel like I've made it now on Zoom at 8, having you here. You're just such a treat to have, and so knowledgeable that you would share all of your information. And this is probably this much of what information that you could share with us. And I hope that maybe there would be a way we could have you come back another time and share more information to help our investors.